For consultants and other self-employed people, one of the surprising things oftentimes is that they can save more towards retirement than they could have if they were working for a larger company as a W-2 employee. We're going to talk about some of the different savings vehicles that you can use if you're a consultant or are a self-employed individual.
So Spencer, in a previous episode, we looked at the possibilities of consulting in retirement, the benefits, the downsides, the tax advantages and disadvantages therein. And so we kind of touched a little bit on some of those savings opportunities, but today we want to dive a little bit deeper into some of those accounts that folks can save into with consulting income. So why don't you walk us through first just why consultants, if you're a 1099 employee, can save at a higher rate? And then let's talk through some of those accounts. So what levers can they pull to be able to save at that higher rate?
Well, let's take a step back and first think about the 401k or the 403b and the savings limitations that most folks who work for large companies have. You typically, again, everyone is a little bit different, but typically you'll have a limit, and in 2024, that limit is going to be, as an employee, you can save up to $23,000 per year. If you are age 50 or older, you have a catch-up amount that you can save, which is $7,500. So you can save a little over $30,000 of your own wages towards retirement, which is a substantial sum. Now, your employer typically will match some portion of what you save. Some employers, it's 3%, some it's 4%, some there's a graded level where it might be 50 cents on the dollar for the first 6 or 8%. But usually it's in that 3 to 4% that they're going to match somehow. And then for those plans that are really souped up, then you might be able to save an additional amount after tax above and beyond that. And the IRS guidelines then come in play, and when we look at it for 2024, it's going to be $69,000 per year for those employees who are under age 50, and then again, you've got the catch up there. So theoretically, it could be up to $76,500 in 2024, all in. But there's not that many plans that actually allow you to go that high, because most plans are not structured in a way where you get that after-tax savings potential. So for most folks, if they're age 50 and older, they've got about $30,000 they can save, and then they get some kind of a match, from their employer, and then a lesser amount for those who are under the age of 50. What the different plans that we see in this space offers is whether it's a solo 401k, which can get you up to that highest amount that we were just talking about, or a solo defined benefit plan that can get you sometimes up to 3 times what amount that we were just talking about, even over $240,000 in certain circumstances. There's a lot more latitude of how much you can save and the different types of plans that you can use depending on your circumstances. So we'll be able to dive in a little bit more to that today.
Okay, so let's go ahead and start off with that solo 401k plan. So what are some of the limitations? How does one set up a solo 401k? What all is involved in taking that route if you have some consulting income?
Right, so this is the easiest to kind of say, well, we've got the traditional 401k over here and we've got the solo 401k over here, because so many people know the traditional 401k from a large employer plan. A solo 401k, you're going to use it, as the name would imply, if you are the only employee, or if you have you and your spouse as the only employee, basically, there. What you have is the opportunity to contribute both as an employee and as an employer there. And so on the employee side, we have the same provisions that we do from that larger plan 401k that I just kind of enumerated, the $23,000 on the employee side for 2024, along with a catch-up of $7,500. The employer side, though, is different. The employer side, you can give a little, or you can contribute a little bit less than 20% of your Schedule C income there. So I say a little bit less because there is an adjustment that you have to take out for payroll tax that's in there that makes it a little bit less than 20%. But let's just say you had consulting income of $100,000, and that would be Schedule C income. So your net income there of $100,000. While you could contribute $23,000 as the employee, if you are over age 50, you could contribute another $7,500 next year, so you're a little over $30,000. But then the kicker is that you could contribute, again, 20% of that Schedule C income, almost. It ends up being, I think, about $18,500. But you would contribute that as your employer match, or as the employer side of things, again, up to 20%, almost 20% of the Schedule C side. So on $100,000 of income, you could get close to $50,000 of contributions. Yeah. And if you had $200,000 of income, you'd have even more. You'd have another $18,000 or so that you could contribute, again, there on that side of things. So it can be quite substantial what you can do on a solo 401k. The absolute limit is the same as we would find in a larger company 401k, and that, again, $69,000 would be the contribution limit between the employer and the employee side if you're under age 50, and then you get that $7,600 or $7,500 catch up for those who are age 50 and older. So the top line is the same. Now, one of the things to recognize as well is you can also do a solo Roth 401k. That's relatively new, but you can make employee contributions. That would be both the employee general amount of $23,000 plus the catch-up of $7,500. Both of those can be on the Roth side. The employer match, that 20% of Schedule C income, or just a little bit less than that, that has to still be on the pre-tax side of the solo 401k. So if you do go that route and you want a Roth solo 401k, then you will have two types of resources going in, or two types of accounts from a tax standpoint there. But a lot of flexibility. And the nice thing with a solo 401k, the administrative components and costs are not that high. Mm-hmm. For a lot of different institutions, they will allow you to use kind of their stock language for your solo 401k setup. And so, you're not having to pay high costs in terms of that setup. And then there's not usually a IRS required filing for that plan itself until that plan has at least $250,000. Usually at that point, there's a Schedule 5500 that you've got to file there, which if you work with the CPA, that might cost a little bit to do so. But again, fairly simple relative to the amount that you can save there overall.
Great. Thanks for those details. So we've talked a little bit about the solo 401k. You mentioned that the solo defined benefit plan has a higher amount that you can set aside into it. What's the benefit and what's the downside to a solo defined benefit plan?
Well, if we, again, circle back to the solo 401k, one of the things is the flexibility of it that I should have mentioned. You could put in, $50,000 in 1 year because you had enough earnings and you wanted to do so, and you could put in nothing the next year. The solo defined benefit plan, we need to make sure that there are typically more consistent levels of income and a consistent approach to the amount that is saved. If there are things that come up that are unforeseen and you couldn't know them, then there are ways that you can adjust the plan. But you think about the solo defined benefit plan, and it's wonderful, but there's a higher level of cost to set it up and to administer it, and there's more hoops that you've got to jump through along the way. Now, the trade-off is that you get a much higher level of savings that can be pushed towards that plan. Again, in some circumstances, over $240,000 of income per year can be deferred in that direction. Now, things that I want to make sure that you know here are that there isn't a Roth option here. It is pre-tax, all of those resources going in. There are more hoops that you've got to jump through. You actually need an actuary to run some of the numbers to typically to tell you how much you can contribute in a particular year, because it's age-based in some ways. The older that you get, to a certain point, it's going to help you. So you wouldn't see typically a 30-year-old go towards a defined benefit plan because they're not old enough for the calculations to work out well in their favor. They might only be able to contribute $20,000 or $30,000, younger in their career or earlier in their career. As they get later, typically for folks who are 50 to, let's just say age 50 to 70, this is right in their wheelhouse where they can get the most and be able to contribute the most based on their age and based on the actuarial calculations there. So there are a lot of hoops that you've got to jump through there in terms of the plan setup and administration annually. Typically, these costs do add up as well. So we think about a typical account setup, and we use a third-party administrator to do all of these different pieces for our clients. But typically you're talking $1,500 or more to set up the plan. And then it's going to be an administrative cost of at least $2,000 a year and potentially more to be able to administer the plan and help to make the calculations, file the Form 5500, all those kinds of different pieces. So we need to make sure that someone is able to put away enough to justify that. Because we wouldn't want somebody to put away $5,000 to a defined benefit plan, but then have all of these costs associated with it. We need to have someone able to put away maybe $100,000 or more based on the actuarial calculations and their cash flow capabilities. So these plans would usually be for folks who make at least a couple $100,000 a year. But again, you look at certain folks, and whether this be an emergency room doctor or a consultant who's kind of a one-man band or one-woman band, you have the capacity to save at a much higher level. So let's just say income was $400,000 and you are 55 and a consultant. You might be able to put away $240,000 of that income and defer that in terms of taxation. So it could be a boon to you.
Yeah, absolutely. So Spencer, there are some uniquenesses to a solo defined benefit plan. One of them is investment selection. You want to walk us through what's different about a solo defined benefit plan?
Yeah, so all of these other options, if we think about solo 401k, we think about SEP IRA, Simple IRA, Traditional IRA, and a Roth IRA, really you can choose your own adventure in terms of how you make those investments. Could be very, very aggressive, could be all stock, alternative investments, could be very, very conservative, could even be all cash there or bonds. When we look at a solo defined benefit plan, because we have the actuaries involved and there's this complex calculation that basically a defined benefit plan, if we think back to 40 and 50 years ago, defined benefit plan, of course, is the pension plans. About 25 years ago, the law was updated to allow for these solo plans being in place. So some of the actuarial calculations that were taken from the pension plans and how they were set up for a lifetime benefit that would be paid out to folks, some of that was ported over so that you could then do some calculations so that you could have a lifetime benefit on a solo basis. Now, the challenge here is that as the actuaries put things together and jump through the necessary hoops for these calculations, we need to have a more steady level of growth, less volatile level of growth than we might find if we're very, very aggressive in terms of our investment. So we'd find that usually we'd end up with the solo defined benefit plan being more of a balance between stocks and bonds, not so much of a really, really conservative or really, really aggressive side of things. So it doesn't mean that you couldn't be tilted a little bit more aggressive, but typically, again, because of wanting to keep those account values growing at a more or less steady level, we don't want to see those assets drop 40%, as could be the case if we had a really bad down market. We might want to see a balance of stocks and bonds such that the worst performance might be down 15 or 20%, if at all possible. The solo 401k and SEP IRA and these other types of plans, they don't have these actuarial components where we need to have a more steady and consistent level of income and growth. By way of example, if we ended up towards the end of a solo defined benefit plan and we had a big year of growth, let's just say we were very, very aggressively invested and we saw that plan grow by 30%, well, that could be really bad because it could trigger a tremendous amount of taxation because we went through the roof, we went through the ceiling of where the plan should be, which can impose all kinds of penalties and all kinds of different challenges. So we've got to be a little bit more careful with how we make those investments, and typically they're more middle of the road as we look at it.
Got it. Well, thanks for walking us through those two solo plans. Mm-hmm. We want to shift a little bit and say there's a couple different IRA options that you can look to invest into. Mm-hmm. You've got your SEP, your Simple, and then just the traditional and Roth IRA options. Mm-hmm. So let's walk through first the SEP IRA. Outline a little bit of what is a SEP IRA and how it can be helpful.
Well, a SEP IRA is really tailored towards a higher level of contribution, again, than you would find in a traditional IRA. And for employers, there are different ways that you could set up a SEP IRA. And if you have multiple employees, you can make contributions for them. The way that we see this work out, typically, again, we have an individual that just wants to make contributions, is a solo consultant, or does some work themselves. So they're able to contribute, again, about 20% or just a little bit less than 20% of their Schedule C earnings. So this is kind of like a simpler version of a solo 401k. The administration is a little bit simpler as well in terms of the setup and in terms of the ongoing filing there. Sometimes there's less expense to that as well. The maximum contribution also is fairly consistent with what you would see with a solo 401k. The maximum for 2024 is $69,000. So we don't have that catch-up amount there for folks who are age 50 and older, but you get most of the potential benefit there if you are a higher income individual versus, say, a solo 401k.
Right. That's great. Okay, so let's talk about the Simple IRA now. So the Simple IRA has a lower level of contribution, and there's some extra requirements. So talk us through the Simple IRA.
Well, Simple IRA would typically be used for small firms that have multiple employees. We use a Simple IRA at our firm. A Simple IRA wouldn't typically be used for an individual, kind of a one-person business there, but it can be. The provisions, again, for a Simple IRA, you have a employee-based contribution level that can be up to $16,000. If you're age 50 or older, you have a $3,500 catch-up. There are ways that you can set up a simple Roth in 2024 and beyond. And for most employees, you have a 3% match. So this plan is really tailor-made for, say, businesses that might have somewhere between 2 and 100 people because it's a simple IRA. That's one of the reasons that they came up with the acronym. It's fairly straightforward in terms of the setup process and choosing a financial institution. Most of them offer, simple IRAs, the large custodians that are out there. You do have a employer contribution requirement here, either a matching or a non-elective, element. And again, it's typically for these smaller firms in terms of company size, but not so much tailored towards a one-person business.
Right. All right. So Spencer, we kind of started with those big options. You really want to save as much money as you can. You put it into the solo 401k. If you've got a lot of income and you're the only practitioner, solo defined benefit plan, if you're pushing hundreds of thousands of dollars in, could be a good option for you. Really aggressive savings. Let's say we're only taking on a little bit of extra work and we still want to save, but we don't want the extra expense and the hassle to set up a solo 401k, solo defined benefit plan. Here comes in the Roth IRA and the traditional IRA. How does this help a consultant?
Well, if you don't have any access to a retirement plan, neither you, and if you're married, neither you nor your spouse do, then you have a capacity in particular, regardless of your income level, to be able to contribute to a Roth or a traditional IRA. And this can be a nice option. As you mentioned, you might have retired and you've got just a little bit of income, you do a few hours of work here or there, and maybe you have $20,000 of income or less there. Then this can be nice in that you can make a contribution and it's going to be taxed over time more preferentially than, say, putting those resources into a non-qualified account typically. So a Roth IRA, you have a contribution ceiling of $7,000. You can't contribute any more than $7,000. Once you turn age 50, you have a $1,000 catch-up. So there's a potential that you can contribute up to $8,000. You and your spouse there. So let's just say your spouse doesn't have any income in retirement. You have $20,000. Why your spouse could take just provided that you have income for both of you, your spouse could be able to utilize that earned income for their contribution there to the traditional IRA or Roth IRA there. So we think about this as a household income, not just as an individual income. Now, if you're contributing to one of these other plans, whether that be you're a W-2 employee and you are contributing via a 401k, or let's just say you've set up a solo 401k, then we've got some limits there in terms of what you could do with a Roth contribution. And these would be income limits, typically. So we've got south of $146,000 for single filers in 2024. You can make a full Roth contribution. South of $230,000 for those married filing joint folks, you can make a full Roth contribution. Now, if you're within, say, $10,000 to $15,000 above that, then you may have the opportunity to make a partial contribution there. That always tends to be a little bit dicey because most of the folks, they don't know exactly where their income is going to fall at the end of the year. And so they're wondering, do I have the capacity to be able to make this contribution and make a partial contribution? But if you know that your income is going to be solidly less than that, your modified adjusted gross income, I should say, is going to be solidly less than that, then you may want to be able to make a Roth IRA contribution, again, for up to $8,000 if you're age 50 or older. One of the nice things there too is that if you have a non-qualified account and you're thinking about, okay, well, how can I slide these resources over maybe to a more tax efficient place? What you might do is take a distribution from the non-qualified to be able to make sure that you could make a Roth IRA contribution. Again, if you're earning $20,000, so you and your spouse would be able to make that contribution there, but not jump through all of the hoops of setting up, say, a solo 401k or one of these other types of accounts that is more difficult there.
Right. So thanks for walking us through those investment options for consultants in retirement. If you have questions about opportunities to save as a consultant in retirement, we'd love to hear from you. And with that, clients, we look forward to seeing you again soon. Take care. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.